Good afternoon, everyone, and thank you for taking your time to join with us today. In the spirit of reconciliation, Sunsuper acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We make particular mention to the Gadigal peoples of the Eora Nation here in Sydney, as well as the Boonwurrung and Woiwurrung peoples of the Kulin Nation, from where we are also presenting from Melbourne. We would like to pay our respects to elders past, present, as well as emerging, and extend that respect to all Aboriginal and Torres Strait Islanders across our land. I'd also like to take this opportunity before we start to acknowledge that many of us are in lockdown today, including your presenters who are based both here in Sydney as well in Melbourne. We do want you to know that our thoughts are with you, and we do hope that you are getting through these times safely. Now, we last presented to you in May, and this was a time of significant uncertainty around the economy, as well as new budget announcements and legislation, but primarily around obligations that you had that we knew were going to be commencing soon. We also reflected on the significant and exciting changes that are underway for Sunsuper. Now, today we'll continue to look at those discussions, but we want to provide you with clearer guidance today, certainly in regard to your changing obligations, now that we have some clarity from the government and the Australian Taxation Office as well. So what I would like to do is to introduce our co-presenters today. We're actually joined by Dave Woodall, who is our Employer Growth EGM, and he's joining us from Melbourne, and I will cross to Dave in one moment. But I would like to also thank Brian Parker, our Chief Economist, someone who is known to many of you, for joining us today. Now, we do have a large number of you who have pre-submitted questions to us, and that is going to be reflected in our content today. And we thank you for taking the time to do so. But we also know that today's session will generate questions from some of you as we go through. So we do ask you to actually pop those questions that you have within the submit a question box, which is located on the screen that you're joining this function through. Also, if any of you are finding that the viewer screen is too small for some of what we're covering today, please know that you can maximise that viewer as well. Now, before I do hand over to Dave, though, I would like to acknowledge that the information we're covering today is of a general advice nature only. We want you to certainly take on this information and explore it for your own needs, but know too that we are here to support you. And if following on from today you have any questions or any areas of concern that you would like to explore further and personally, please reach out to us on 13 11 84 or by visiting our website at sunsuper.com.au. Now, it is my pleasure to hand over to Dave Woodall, who is our EGM of Employer Growth, and Dave is joining us today to provide us with an update on Sunsuper. So over to you, Dave. Good morning to you in Melbourne.
Yes, thanks very much, Josh. Thank you very much. Great to join you and Brian. And just before I start, just to further reiterate your opening remarks for everyone on the call that's in your own version of lockdown around the country, I hope that you're able to get the support that you need, but also that you're able to provide that support to others, whether it be friends, family, or your colleagues at work. At Sunsuper, we are a profit for member fund, and that gives us every day a really clear, singular focus on what it is we need to do to help members. And it means that those members who are your employees are really at the centre of our decision making. We run our fund to support members to achieve their best retirement outcomes so that they can fulfil their retirement dreams. And we're very proud that this focus on members has continued to be recognised by the industry. And in 2021, we have been awarded the Chant West Best Fund Member Services And we've also been awarded in 2021 the Super Ratings My Choice Super Fund of the Year. And whilst this focus on members and the industry awards that we've received are great, we do recognise that many of these members come to us via you, the employer. And so equally, we have a very strong focus on supporting employers and delivering services that make us easy to deal with. And our focus on servicing you, which is part of today's update, and delivering information in a timely fashion. This was also recognised by ChantWest, who awarded us their Corporate Solutions Fund of the Year for 2021, which in fact was the 6th year in a row we've received that accolade. More recently this year, we've also received the Super Review Best Corporate Solutions Award as well. So whilst it is great for all of our staff who work very hard to receive this industry recognition, we are, however, always looking to see where we can do better, which really brings me to comment on our proposed merger with QSuper. Now, many of you may well be aware that back in March, after a period of substantial due diligence, Sunsuper and QSuper signed a heads of agreement with the intention to merge, which would create a sort of $200 billion plus super fund with more than 2 million members in the industry. And that heads of agreement was announced following detailed due diligence where a strong business case for contemplating the merger was developed, and both boards of those funds formed the view that it would be in the members' best interest, the members of both QSuper and Sunsuper, to further investigate the potential benefits of such a merger, which would create one of the largest funds in the country and would bring to our members and our employers greater benefit through scale and the combined capability. And I know that on both sides, there's a great excitement around what this could mean, what the outcomes of this merger could mean for our members and for our employers. In an industry where scale does matter, the opportunity for the merge fund to further enhance services and benefits is very exciting to us. The merger is still subject to some regulatory and legislative changes and board approvals, and we are working collectively on seeking those approvals and proceeding with the merger throughout the balance of this year. But we will keep you updated as we work together and keep you updated on the progress in that regard. So whilst we're very confident that that merger will be in the best interests of all of our members, we haven't forgotten that while we're doing that, we need to remain present and keep our focus on our day-to-day activities, helping members grow their retirement savings. And whilst I'm very tempted to steal some of Brian's thunder, our 12-month and in fact our long-term investment performance that Brian's going to share with you, I think is great evidence of us continuing to keep that focus on the present and making sure that we're generating the best performance that we can to create value for our members and your employees. So getting very close to stealing his thunder, but not quite. I'd love to hand over to Brian to take you through, our Chief Economist, to take you through the investment commentary.
Thank you very much, Dave, and thank you very much, everybody, for your time again today. I think the last couple of years has been just an extraordinary period for the world in general, at the risk of stating the bleeding obvious. After a terrible March 2020 in a financial sense, we've seen this extraordinary recovery in financial markets, and later on, we've also seen quite a solid recovery in the economy over that time. And that's a lot of the questions I get asked when I actually talk to members and talk to clients about the last year or two is, when the world has gone through this extraordinary period of time where, the COVID crisis is far from over yet. Why is it that share markets have actually performed so strongly over the last year or so, given that, COVID is still with us? And I think the short answer to that is there's probably several parts to that. Firstly is the extraordinary policy response and just the efforts from governments and central banks around the world to put in place the policy support measures to allow households and businesses to come out the other side of the COVID crisis. But also later on, the news about vaccines is very much a game changer. Now, as we've seen, vaccine rollout is going to be an ongoing process. The pace of that rollout has fallen short of expectations in a number of countries, including where we are right now. But over time, the important point to remember, I think, is that there is a light at the end of the tunnel, that vaccines are definitely a game changer and that we will get through this. And that's really what markets, I think, have been telling us. The fact that markets have been able to look through various setbacks with, resurgence of infections or disappointments with vaccine rollout. The fact is that markets are telling us that there is a light at the end of the tunnel, and it is not a train. It's the end of the tunnel. And I think that's an important takeout, especially as we go through another very, very tough period of lockdown right now. The returns have been really quite phenomenal. We've had the best year in over 25 years in terms of Sunsuper's performance for the year to June. In terms of where we sit today, I think one of the other key messages I want to leave you with at the end of my session is that nobody should do their planning for the future assuming that their balanced portfolio does better than 20% year in, year out. That we've seen an extraordinary recovery in markets and that longer term returns are likely to be markedly lower than the kind of returns we've seen in the last 12 months. In terms of markets and strategy, what are we seeing? Thankfully, we're still finding the kind of investment opportunities, especially in the unlisted asset classes, that are capable of delivering the sort of returns, real after-tax, after-fee returns that our members need, and that's really pleasing. If we look at share markets, we think there is still, share markets still look attractively priced, especially when you compare them to the future returns on cash and fixed income and term deposits, where future returns are likely to be very, very low indeed. So overall, the economic recovery is ongoing. That what we are going through is a very severe setback here in Australia, particularly in New South Wales and Victoria, but there is a light at the end of the tunnel. And the vaccine rollout is gathering steam, and those vaccines are the ultimate way out of this crisis. If I go to the next slide, this just shows you the performance of Sunsuper's balanced option. Probably over 80% of the money we look after on behalf of members is managed in this way. We have very little control over where we will rank in a performance survey over any given month or quarter or even year. Our aim is to do two things as an investment team, and there's over 40 of us who normally reside at this office here in Sydney. Our job is to do two things. One is to make sure that we deliver the long-term real returns that we tell our members that we are aiming for, the kind of real returns that our members need to live their retirement dreams, but also do it in such a way that our returns are competitive over the medium to longer term. What this chart shows you is that over a range of time periods to June, that Sunsuper is comfortably ahead of the median fund over all time periods, and indeed we rank in the top quartile of funds over most time periods in this survey, which is very pleasing. But most importantly, the absolute returns have been very, very strong and well in excess of the real return objectives that we communicate to members in our product disclosure statements. If I go to the next slide. Now, this is a very ugly slide, but please bear with me. Again, those of you who've seen me present before will know that being an economist by trade, I have an obsession with confusing, colourful slides, and this is just what I do. This just shows you the value of $100 invested at the end of 2019 across a range of asset classes that we invest in. Some traditional asset classes such as shares and fixed income and cash, but also the key alternative asset classes, especially the unlisted asset classes that we invest in on behalf of members. The thick black line in the middle is the value of $100 invested in a blend of all those assets. That is our balanced portfolio. And there's a few key takeouts I want to leave you with from this slide. Firstly, is just the speed of the recovery. In other presentations to members, I've described March 2020 as kind of like having the global financial crisis compressed into about 2 to 3 weeks. It really was an extraordinary period for financial markets, but also the speed with which things turned around has been quite phenomenal. And I don't think anyone saw that coming, especially given that, as we've talked about previously, the news on COVID certainly wasn't getting any better, but yet financial markets were looking ahead and seeing that light at the end of the tunnel. So what we've seen is a very, very sharp rebound in markets, a very solid recovery in the performance of the balanced option, 20.7% return for the year to June. The other thing I'd highlight from this is that what we tend to find is that share markets recover first, our unlisted assets recover later. So what we're starting to see now is that this global economic recovery and the improvement in the underlying businesses that we invest in is starting to be reflected in the valuations and in the performance of our key unlisted asset classes. In other words, property, private equity and infrastructure businesses. The next slide. Let me just share with you some of the assets that we've invested in. Now, some of the assets that we invest in on your behalf certainly did suffer from the COVID downturn. And the most notably, the most obvious example of this is our airport assets, where we had to move very, very quickly to make sure that we marked down the value of our airport assets in March last year to reflect what was going to happen to the environment for those assets. But other assets in the portfolio actually did very well. This is Safehost. It's a business in Switzerland that we own equity in. It's a data center business. The major tenant of this data center is Microsoft. It won't surprise anyone on this call to know that Microsoft are clearly still paying their rent. These are the kind of assets that, as part of a diversified portfolio, have actually done very, very well for us over the course of COVID. If there is such a thing as a COVID-resistant or COVID-proof asset, the data centers have certainly proven to be that. The next slide. One of the other things which has been quite staggering is just the massive rebound in world trade that we've seen over the last year or so. What this chart shows you is the volume of goods being shipped through ports and airports around the world over time. And that massive fall that we saw early last year as the whole world went into lockdown, the speed with which that has reversed has been really quite staggering. The volume of goods going through ports and airports is actually higher today than it was pre-COVID. The speed of that recovery has been really remarkable. While the services parts of the economy have taken longer to recover, and in fact are still in recovery phase, the demand for goods, call it the online shopping phenomenon, as a case in point, the recovery in that demand for goods across the world has been really quite staggering. The next slide just shows you one of the assets that we hold in the portfolio that's actually benefited from this. Now, this is the Long Beach Container Terminal in Southern California. In a master stroke of timing, we actually chose to invest in this asset at the end of 2019, sadly, just before the biggest recession in any of our lifetimes. However, we actually factored in a near-term recession into our due diligence when we were deciding to buy this asset. And we worked on the assumption that even if there was a recession, a very sharp one, early in our ownership of the asset, it would still deliver very, very good returns for members. And that's exactly what it's done. And it's been a key beneficiary of the very, very solid recovery we've seen in world trade. It's a phenomenal facility that continues to deliver very good returns for members. The next slide. I can't avoid commenting on what's happening in the Australian economy right now. We were seeing a stronger than expected recovery in employment and in production. That has clearly come to a halt in the September quarter. And we've seen a fall in employment over recent weeks. That's shown in the chart on the left here. This is the ABS's weekly payroll survey. Clearly, New South Wales and Victoria are bearing the brunt of these falls in employment. We're also seeing a big hit to consumer and business confidence. However, one thing I think is worth bearing in mind, the impact so far on confidence and on activity, or at least on employment, is not as severe as we saw in the first half of the year. And I think that's probably going to continue for a little while yet, especially as vaccines get rolled out, as the pace of vaccine rollout accelerates over the next few months. We should be able to see a recovery in the economy and a recovery in confidence and employment and production. The next slide. There is also another reason for optimism, if you like, is that there is still plenty of pent-up demand out there, or at the very least, plenty of dry powder. This just shows you the percentage of our income as households that we are saving. And it's for a range of countries, and each of the bars that I'm showing, each of the columns I'm showing is for different time periods. The dark blue bar is what we were saving out of our income pre-COVID. The light blue bar is what we were saving during the depths of COVID, where it's not as if a lot of us didn't have money. It was simply that we were not allowed to spend it on the things we normally buy, most notably going out and spending money on services. The yellow column is what we are saving, at least the latest available data. And what it shows you is that even though we've started to spend more money, we are still saving a higher share of our income than we were pre-COVID. As vaccines continue to be rolled out, as confidence as confidence eventually improves and economies reopen, it's a fair assumption that this money is going to be put to work, that we will continue to spend and start to spend a higher share of our income. How will that affect Sunsuper? It will certainly affect the economy very, very positively. We were likely to see that flow through into a range of our other assets as well. If I go to the next slide. Many of you will know that we are Australia's largest owner and operator of holiday parks. We own the Discovery Park network around Australia. This is the park on Rottnest Island. That is a very, very nice place to holiday just quietly. What we saw after the first lockdowns in the start of last year is that once people were allowed to travel again, even within their own state, they did. And this business, the Discovery Parks business, has performed extremely well for Sunsuper members over what has been a very, very difficult environment. Over calendar year 2020, with COVID lockdowns, and before that, bushfire season on the eastern seaboard, this business actually delivered a positive return for members during 2020 and continues to operate very, very well under, especially currently, very, very challenging circumstances. If I go to the next slide. The other thing I wanted to share with you is a quick comment on interest rates. One of the challenges in building a diversified portfolio right now is that the yield available on defensive assets is very, very low. This is the yield available on 10-year government bonds, both here in Australia and in the major bond markets of the world. Because these yields are so low, it means the future returns are likely to be very, very low as well. And which means that as a provider of retirement income, we need to make sure that we have access to assets that are capable of delivering both reasonable growth, but also strong income. And thankfully, we're still able to do that. I want to share two assets that we've acquired on your behalf in the last few months. The next slide. Puget is the largest electricity and gas distribution network in the northeast of the United States. This is a business that is in transition. In Washington state, they have very, very aggressive plans to decarbonise their economy, most notably decarbonise their energy sector. This is a business that is seeking to raise capital, the capital we're happy to provide, and this is a business that is going to transition to literally be zero carbon in terms of its electricity production within the next 20 years. We will help to facilitate that process by our ownership of this business. It is already, and in the process, it's still likely to deliver very, very strong income returns for our members. The next slide also, perhaps an asset closer to home. You may have read in the press that Telstra decided to sell a large chunk of its equity in its Infraco Towers business. We were one of the people that acquired that equity alongside the Commonwealth Superannuation Corporation and the Future Fund. This again is an asset that is likely to deliver very good long-term income streams for our members, which will be very, very valuable in a low interest rate and low bond rate environment. And if I can finally just close on one key point. Next slide. I mentioned in the introduction that the returns have been very, very strong. I want to highlight just how strong. This chart shows you our three key diversified options: our growth, our balance, and our retirement option. The dark blue bar is the real return objective that we put into our product disclosure statement a decade ago. What we told members they should reasonably expect to achieve in terms of a 10-year return. Well, what was actually achieved was the light blue bar. And given what we have been through in the last year, the fact that superannuation funds in general and Sunsuper in particular has delivered a return that is significantly higher than that real return objective is really quite a staggering result. But going forward, I really want to stress this. Nobody should expect that the kind of returns we've seen in the last 12 months are anything like sustainable. If I pick up a product disclosure statement today from Sunsuper or indeed most other superannuation funds, what's the real return objective? It's the yellow bar. Over time, we would expect our balanced offering to deliver about 3.5% above inflation after fees, after superannuation tax. We think that that's the kind of real return which is achievable and sustainable over time. And it's important that we have realistic expectations about what sort of returns are achievable and sustainable, especially in a very, very low interest rate environment. And with that, I'll hand you back to Josh. I look forward to answering your questions shortly.
Brian, and my thanks to you as well, Dave, for your opening comments. Now, investment performance and also the member benefits that Dave spoke to are absolutely vital to your employees' future. And I'm sure Dave will attest later on as well, and has already mentioned, it is their trust in you that will often guide their decision around superannuation. It is for this reason absolutely important that you not just partner with a strong superannuation fund, as we've seen through the investment performance that Brian has spoken to, but that you are absolutely aware of your own obligations in fulfilling your super needs for employees. So I actually see current obligations and new obligations coming in on the 1st of November as being both a mix of your duty of care as well as your legislative responsibility around superannuation. Now, in May, we actually talked about the fact that the government had announced a number of key changes to superannuation in last year's budget. And one of these is in a direct impact upon how you look after your employees' superannuation obligations. When we spoke to you in May, we didn't yet have a commencement date. We now do. It is the 1st of November. From the 1st of November, you won't be able to automatically default any employee to your chosen super fund where they do not complete a choice of fund form. Instead, for any employee that doesn't complete a choice of fund form, you will need to search on a new ATO search tool for the existing super fund that that employee may have, and it's to that fund that you will need to make contributions. The reason for this, and we fully support this, is that the government hopes this will reduce people getting multiple superannuation accounts, especially when they're younger or when they're in casual employment, as they move from job to job. And as I said, we fully support that intent of the measure. Where, though, we support that intent, we do have some concerns that we are going to see a large group of members, or a large group of Australian workers rather, who aren't really engaged with their super and who aren't going to be making active decisions, and instead could actually have a poor performing fund continue with them from job to job. And it also means that they could be blissfully unaware of the benefits that other funds, particularly those that you may offer through their employment with you, that they'll be unaware of those arrangements. So the last thing before I move on is that it's important for you to note that these obligations don't reside with employees, they don't reside with super funds, they squarely reside with you. And this is something I'll come back to shortly. Now, if we just move on, the first thing I want to make very clear here is that these obligations will not apply to people who are already employed with you. This will only start for new employees that you have come on to your employment from the 1st of November. So for current employees, you will simply continue to pay their superannuation contributions as you currently do. Where the change is, and this is shown on the next slide, is that from the 1st of November, you're going to have a couple of paths that you'll need to consider when you're onboarding a new employee. The first is probably the simplest for you. Well, not probably, it absolutely is. Where an employee gives you a choice of fund form, it means that you simply do what you currently do. You take that choice of fund form and you make contributions for that employee to that chosen fund. Where the change is from the 1st of November, where an employee does not make a choice of fund. You will need to now contact the ATO, and what you'll get from the ATO through their system, and I'll come back to that system shortly, is one of two responses. Firstly, that the ATO has identified that the employee has an existing super fund account, and that is where you'll need to make the super contribution. The second response from the ATO, though, may be that that employee does not have an existing super fund, so you may actually be their first employer that is paying super, and in that case, you can then make their contributions to your default fund. So what you're seeing here is that that second call to action is the new measure in this. So if we just move on, what I want to do is just, although we've shown that visually, I just want to again endorse that just through some words, that we know for new employees that choose a fund, that complete a choice of fund form, that their existing, the existing requirements and processes will continue to apply. So there's no change there for you. Where the change will be, and this is shown on the next slide, is that from the 1st of November, for new employees that don't make a choice of fund, remember you are going to have to contact the ATO for each individual employee. And the ATO will then inform you as to whether they've got a super fund already that you need to pay to, or if they don't, that, as I said, you will make that payment to your default fund. So let's look at how these obligations are actually going to come into place. The ATO has announced only in the last few weeks there is going to be a 3-phase introduction here. From the 1st of November, these new obligations will come into place, but the ATO has said that there will be a transitional period, and that means a number of things. Firstly, between now and July next year, the expectation is that this process will be manual. Okay, and I'll go through that manual process in a moment. So that's the first thing you need to be aware of. For the first 6 months or so, you will need to manually be following these obligations. The second thing the ATO has announced is that over that 6-month period or so, it is their intent to provide guidance to employers. And this is really important. Where an employer shows intent to have actually met the obligations, the ATO will not penalise you. Okay, so over the next 6 months or so, the ATO is basically going to use that time to just support you. From the 1st of July next year until the 1st of November, the ATO is expecting that online systems will come into place, and then from 1 November next year, they will fully implement this change, and from 1 November next year, penalisation will actually apply. Now, what constitutes, or how do you actually have the ability to submit information to the ATO? Well, the ATO is going to have a new request stapled fund online service, and they have started releasing information on this, which I'll come to shortly. But the important thing from your perspective is that you cannot use this for an employee. You cannot actually undertake this process until an employee has commenced employment with you. From the ATO's perspective, commencement of employment means that they've either completed the TFN declaration or that you have done a single touch payroll process for that employee. Again, I reiterate two things. This will be a manual process, at least for the first 6 months or so. And secondly, if your employees make a choice of fund, you will not need to go through this process at all. So, in thinking about how this process actually looks and feels, what we're showing here is a couple of screenshots that the ATO has supplied as being proposed for the Stapled Fund online service from the 1st of November. And what you can't see here is that for each employee, you will have to enter in details, including their name, date of birth, tax file number, as well as their address. You then submit that request for each employee employee, and the ATO will provide a response. That response will be that they either have a fund, an existing fund, and the ATO informs you of who that fund is and to whom you need to pay, or the ATO will inform you that they do not have an existing fund and therefore you can pay to your chosen default. Now, one of the questions we had submitted was, how long will this ATO process take? Well, the ATO's official line on that is that for you to actually undertake this manual process for each employee, each response will take, in their words, a few minutes. Take that as you will. Now, the only other thing is that the ATO has announced there will be some form of bulk upload process for where you are actually doing large-scale notifications. So we rate that as being 100 plus employees. We do not have additional details on that, but we certainly will keep you updated between now and the 1st of November as that comes online. So what if an employee, though, has multiple funds? Well, again, this is a little bit grey, and this, again, is a question that someone sent through to us. What will actually happen is where an employee has multiple funds, the ATO will first look at whether that employee, after 1 November, has already been stapled to an existing fund. So you know that won't apply come the 1st of November. That will be later down the track. What they'll then do, where a stapled fund doesn't exist, is they will look at which fund has received the most recent contribution. Failing any determination there, they'll look at which fund has the largest account balance, and failing any clear determination there, they will then make a determination themselves as to where you should pay. We have no understanding as to how long that process itself may take, but we do believe it will be part of that manual process that I covered off in the previous screen. Now, the next thing to think about is how these obligations are going to be enforced. What the ATO has announced, as I've already said, is that from now until the 1st of November next year, they are not going to actively enforce penalties where an employer has shown intent to meet the obligation. So in other words, you have tried to go through the process. That may mean that there are delays for you. It may mean that we're trying to get on top of how this process works. Be aware that the ATO intends to guide you through that period. Come the 1st of November next year, though, the ATO will start to enforce the penalisation. And that penalisation is merely going to be sent to you as a penalty currently would regarding superannuation through the super guarantee charge statement that is issued to you. So this will simply be added as another requirement or another obligation within your choice of fund obligations. And so therefore the same penalisations will actually apply to you where you don't meet those. So there are 4 key impacts that we see from this change in obligations upon you. The first is very obvious, and that's the administrative burden. Where you have choice of funds actively being undertaken by your employees, then that administrative burden is going to be lessened because you'll basically have the same practice that you do today. Where, though, your employees do not actively choose choice of fund or make an active choice of fund, you are going to see that you're going to have to go through these stapling requirements, remembering they are manual, certainly for the first 6 months or so, and you'll need to do that for each employee you onboard. That will be a significant burden for both your payroll areas and also any onboarding teams that you have. There will obviously also be process impacts. You'll need to review, again, where your employees predominantly do not make a choice of fund nomination, where you have previously largely just defaulted them into your chosen fund. You are going to have to look at your existing processes and see whether you need to make adjustments or changes there, again, especially for those of you who have high intake periods of employees. And that's certainly been the case with some of our key employers that I've spoken to in recent weeks and months regarding this change. The third thing here to consider is that with this change and with employees potentially now being stapled to a fund, as we said, that is a good thing in that it means there'll be less chance of them having multiple funds. But what the impact of that is for you is that you may actually see fewer members joining your default plan. And this is especially important where you might be a larger employer and where you perhaps have a negotiated plan in place or something that is part of your corporate offering. If you have fewer of your employees joining that default plan or the corporate plan that you have, you are going to see that the benefits within that will be diluted in two ways. Firstly, you won't have new employees going in or new members going in to actually maintain those benefits that you're receiving, and that might be everything from fee negotiations to negotiated insurance to services through support, as well as things like education. But the other thing it could actually start to diminish is any other benefits that you provide alongside that superannuation offering. For example, at Sunsuper, we have our Dream Rewards program that members can access, which should be a part of the benefits you provide. If you've got employees with multiple funds, you start to see that they'll each have different benefits and you won't have consistency in the proposition that you are giving to them. The last thing, though, is that this is going to certainly have added complexity for you. And what it's likely to mean is that over time, as you see stapled funds continue to be attached to your employees, that there will be a larger number of funds that you will need to work with through your payroll and onboarding areas. And the thing to note there is, as I've said, they'll have different member benefits, there'll be different insurance arrangements. There will also, from your perspective, be different service levels, and you'll have to operate differently with different super funds. We each have our own way of processing and of you dealing with us, and that's something that you really do need to be aware of. But let's think about how this change will actually have an impact on employees and what it can mean for them. Now, as I said, and as Dave has already said, that this is going to have a positive impact in that it is going to reduce, by its intent, multiple funds for employees. They will not get a new fund account every time they change employment. But there is going to be a couple of major impacts. The first is that there is going to be a greater need on them to actually assess where their super is. And let's be frank, most new employees or many of your employees probably don't think about their superannuation arrangements when they join a new employer. Some of them will just stay with the fund they've been with for years without any knowledge of whether that fund is actually performing well, whether there's others out there that perform better. And it also means that they may not be aware of the benefits they can receive through being with your chosen fund, whether that is Sunsuper or elsewhere. So for this reason, it will be vital that your employees, when they commence employment, get very clear information. Not just in regard to your default superannuation arrangements like Sunsuper, but also just in regard to the benefits of using choice of funds, but also the importance of assessing where their super is. Change of employment is a great opportunity for them to think about, is my super going to the best place possible for me? Lastly, and to help with that, the ATO has released already the Your Super comparison tool, which is available on the ATO website as well as through MyGov. And this will give your employees the ability to go online and look at the government's information in regard to comparing superannuation funds. Just one caveat I'd make here is where you have a corporate arrangement, those corporate arrangements won't be reflected. It will actually, in Sunsuper's case, reflect our public offer fund. It won't reflect any special corporate arrangements you may have in place. So before I hand to Dave, I want you to think about the opportunity that this does present to you. And this is something that I'll actually invite Dave to pick up on when he speaks to you in a moment. So this is an opportunity for you to engage employees to be aware of your superannuation default arrangements and the benefits that it can provide to them. Or it may just be an opportunity to encourage them to validate the fund they're with, to make sure actually the fund I'm with is the best possible fund for me to continue to be in. It is also going to be an opportunity for your employees to be more engaged with their super and their choice, but also, I would say, engaged with one of your key benefits. Your super is actually a significant part, not just your obligations, but the super you pay is a significant part of what you actually pay your employees. Instead of looking at it as an obligation, look at it as a very important benefit that you want them to make the most of. So as I said to you, this isn't just an obligation change. This is also a bigger opportunity for you to reflect on your own duty of care when it comes to your employees' future. So we'll continue to work with you closely in the coming months, and Dave will talk to some of this to minimise the impact, including helping you through your new employee onboarding, as well as to ensure that you are supported, and that includes updates like we're providing today and will continue to provide, and it is also with providing you access to resources and to information. Now, I'll hand over to Dave, and once Dave is wrapped up, we will then go to Q&A, noting I've seen some wonderful questions coming through from you. Over to you, Dave, to close things off.
Yes, thanks, Josh. And look, perhaps just to close and provide a slight summary on the material that Josh has covered, we acknowledge that for many of our members, their membership of SunSuper is actually an extension of their employment with you. And being in the right fund should be supporting and should be adding value to your overall employee value proposition. And I think all of our employers can take some comfort if I were to sort of list the top 3 or 4 or 5 reasons that employees benefit from the arrangement you've put into place. It's low fees and costs as a result of being a profit for member model, flexible insurance arrangements, a range of investment options, and the long-term and the short-term competitive performance that Brian had spoke to. Josh mentioned the Dream Rewards program, which we really consider to be an extension of your employees' benefit program. And obviously, 24 access to their account, detailed around contributions, and at no additional cost able to receive advice in relation to their super account. So I think we would argue that your decision to use SunSuper as a default is in fact a reasonable decision to have made. Stapling does have the primary intent of stopping that proliferation of multiple accounts that Josh has spoken to. The proliferation of large numbers of accounts is not in the best interests of individuals, but it may mean that some people who may be in funds that have not performed as well may end up being stapled to them. So we're going at SunSuper, we're going to try to help you manage this new obligation. Josh has talked to you about the mechanics of it today, but we're going to try to help develop some tools to support you in helping members with this dilemma, particularly new members who will join and may be faced with that decision around their staple fund or perhaps the fund that you've determined to be your preferred or your default fund. So in the same way that we've developed over time employer services around Employer Online and Clearinghouse, in the next months we'll be developing a further range of tools and support services to help you engage with those new hires as part of your onboarding process so they can make the best fund choice. And these resources, some of which are available now, but they will be progressively made available at our dedicated stapling resource hub, which is sunsuper.com.au/stapling. And with that, I'll hand back to Josh, and the three of us would be very pleased to take questions. Thanks.
And guys, congratulations. First time in history, I think, that we're actually running a minute and a half ahead of schedule. So, Brian, I'll put that down to you being much better with your pitch than you normally are. We've had a huge number of questions coming in online, and I've been told that there is a theme here that is about, well, what happens if an employee chooses your default? Do you still have to go to the ATO through the stapling online service, or what's it actually mean? Where an employee chooses your default, if they are doing that by using their choice of fund form, if they are using going through those choice of fund processes that exist, that is fine. That is one of their options. They can use that choice of fund form to select any fund, including your default. So as I said, and as Dave has reiterated, we will be making sure that you have the resources and tools available to correctly position that choice to your employees when they start, so that they can actually make a very informed decision in regard to what arrangements they want in place. Now, Brian, I will hand to you in one moment. We've actually had a question that has come through, just a topic that we often get around our net zero target. But before we do, I've just had a question come through from Jonathan asking, will the ATO be providing any service that employers, payroll, HR systems may connect to validate stapled fund information for employees? Yes, you'll actually see that those platform providers for both payroll and HR systems, they are actively working now with the ATO to make sure that they can start helping you to actually do these processes through your existing systems, rather than rely on that manual process that's going to be in place. Now, Brian, Vincent has asked, I understand that Sunsuper has committed to net zero emissions by 2050. Given over 50% of your balance pool is comprised of listed shares, how confident are you that this is going to be achievable when you are relying on other parties to have the same agenda? Do you predict a bigger shift to private equities to help achieve this outcome?
Yeah, it's a good question, and thanks for submitting it. Firstly, the short answer is no, that we don't think we will need to increase our exposure to private equity to do this. Secondly, we're finding that it's not just us. In terms of relying on other parties, what we're finding is that when we talk to like-minded funds, not just here in Australia but globally, that asset owners, that big pension funds, sovereign wealth funds, all over the world are very much heading in this direction. And the way we think about it is really through sort of two lenses. One is very much a risk management lens, and the other is an investment opportunity. As the world increasingly signs on to this, and what we're finding is that this net zero by 2050 is still kind of, I suppose, a consensus position, if you like, amongst a number of governments and businesses and investors all around the world. That in order to get there, that's going to provide opportunities. New businesses, new assets, new investments will need to be made to help facilitate that. So there will be opportunities, but there's also a risk management lens. We want to make sure that we reduce our exposure to those assets and those industries that could potentially suffer from that path, so that those industries and assets that will be negatively affected by that path towards net zero, we want to make sure that we protect our members from being overly exposed to that. So that's the other part of the lens. Exactly how we do it, what we're finding is that it's an ongoing work. There's ongoing work here. This is not something that we get all done within 48 hours. It'll mean that, for example, the benchmarks that we allocate to our investment managers, and also the investment managers that we engage with on behalf of members, they're also moving in this direction too. All their clients are telling them that they want to make sure that that their portfolios actually reflect the path the world seems to be heading down. And so the benchmarks that we give them, the kind of stocks and sectors that we might potentially exclude from portfolios, this is all part of the conversation that we'll be having and also communicating to members over the coming months. So it's both risk and opportunity. We don't think that we'll need to make massive changes to our portfolios in order to achieve it, but you will see adjustments made over the coming months. So we'll communicate that to members over time.
Wonderful. Thanks, Brian. Dave, I'll pass to you in one moment, if you don't mind, to talk about how we've seen productivity of our own staff impacted by COVID over the last 12 months. But before I do that, we've just had a question coming through from Barbara asking how long is the turnaround from the ATO in finding out an employee's super fund when a request is made? Thank you, Barbara. I'll probably just clarify some points I made, that the ATO at the moment said that a request will take a few minutes to get a response on. We're not quite sure what a few minutes means, but certainly if we think about definition, that would be 2 or 3 minutes for a request. So you will need to consider that it will take you a couple of minutes, firstly, to input the data for each new employee, and then a couple of minutes for that response potentially to come back. Now, Dave, Harry has actually asked a really great question, which I think a lot maybe something for us to think about as an employer and a service provider, not purely as a super fund, but is your staff productivity just drastically decreased because your staff are working from home?
It's a very good question. It's a very topical question. And perhaps it's a rare opportunity for me to quote or perhaps misquote Churchill, who said something along the lines of, it isn't enough to do your best, you have to do what is necessary. And I think if we reflect over the last 18 months, and I think about some of the achievements that our people have made whilst working remotely, I think our productivity is at an all-time high. In the last 12 months, we had record inflows of over $10 billion. It's a combination of employer and member contributions, but also large inflows of new employers seeking to join our fund over that time. We had extraordinarily activity around the early release program, where we made hundreds of thousands of benefit payments to get that money in the hands of members through the early release program. We've done more member seminars, more events such as this than ever before. We've reached in excess of 30,000 members and participants and employers through these types of events. And as Brian has sort of referred to, the extraordinary performance, our 12-month performance on our balance fund being 20.1% for the 12 months ending June this year, it also demonstrates our investment team's been working really hard. So I think we're fortunate in some ways. We do our own admin. So there are 1,000 people that work at Sunsuper who actually care about the service delivery. When you appoint Sunsuper as your default fund, you're actually asking the 1,000 employees that work here to get around you and your employees. And that's a very motivating factor. And I think we're fortunate to have a highly engaged workforce and one that was able to pivot. There's that word in 2020 and 21. But we were able to pivot and get the technology to people in their homes very quickly so that we could provide both continuity and uplift of service.
Thank you, Dave. And can I just say, as an employee, I found the last 12 months, yes, have been a pivot, but it's also just been incredible, the support we've had from our CEO through the exec, right through to our peers. It really has been a team combination over the last 12 months that in my 10 years at Sunsuper has been phenomenal to be part of and to actually witness. So Dave, we've got about 3 minutes left. I'm going to throw one question to you, and depending how long you take in response, we might then throw a really quick one to Brian before I wrap up. But Natalia has asked, do you see the incremental increase, so this is in regard to superannuation guarantee, do you see the incremental increase to be applied consistently in the coming years? Or do you anticipate there could be freezes similar to what we've seen in previous years with the SG increase?
Yeah, look, thanks, Josh, and thanks for the question. It's a good question. I think I would want to avoid getting into a policy debate around the merits of the current trajectory or the speed of achieving the current trajectory around the SG level contributions. I would say that Sunsuper believes in that current trajectory and where we want to get to in terms of the uplift in the level of SG. But we've got to be, I'd say, pragmatic around the circumstances and the context. We are going through times that are just unprecedented for most of us. So I think the timing of that trajectory is the question. And I think it is sensible to be conscious of the economic environment, what the unintended consequences of that uplift may be on employers and on members. And so to be thoughtful around how you support the timing of that trajectory. And hopefully I've left a minute or two for another question for Brian.
Well, Brian, you've got about 30 seconds, mate. Are you able to provide some insight into why private capital has outperformed all other asset classes?
Yes, I am. Private capital, particularly private equity, the performance tends to lag what we actually see in listed equity markets, usually by about, call it 3 to 6 months. In other words, if share markets are running hot in a particular quarter, that tends to get reflected in the value of unlisted businesses with a bit of a lag of a few months, because it takes time for valuers to sort of get their act together. And once we get an updated valuation, we put it straight into our unit pricing. And what we've seen is share markets have staged a phenomenal recovery over the last year to a year and a half. And that is, particularly during the June quarter, we saw that reflected in private equity valuations and in returns. Also in very, very strong share markets, that's when private equity managers often take the opportunity to offload their investments to take profits on those investments. So we saw quite a lot of exit activity, and that again banked very substantial profits for members. So it's very much a lagged response to the very strong equity market returns, but also because private equity managers tend to invest more in small to mid cap, so smaller companies, if you like. They tend to they've actually also performed really, really quite well. And so, those we've seen very, very strong results in private equity. But again, results that strong are also perhaps not sustainable over the coming years, if I can reiterate my message from the presentation.
Thank you, Brian. I'd like to thank all of you for joining us today and taking your time to be with us. I'd like to obviously make very special thanks to both Brian and Dave for their contribution and time today. I would like to also, lastly, we've had a team working in the background, looking at your questions coming through, as well as just making sure we've gone to air. So thank you to all of you for making today's event happen. We will be back with you in the future to keep you informed. In the meantime, please jump onto that website, sunsuper.com.au/stapling, to stay informed about these changes and how we're here to support you. We also would like to just pass on to you your good health and best wishes as we continue to go through these times of uncertainty. Keep safe, and we hope to see you in person very, very soon. Take care, everyone, and thanks again.